Welcome to the Retirement Architect with David Reyes. Our program is designed to not only provide insight, but to educate and give you the tools you need to design and build a rock-solid retirement.
And we are here with the Retirement Architect, David Reyes of Reyes Financial Architecture, and always bringing us perspective and guidance on the financial, investment, and retirement planning world. David, right now, no easy task as we are seeing a resurgence in volatility in the market. We are once again testing the lows of 2022 so far. What do you feel is the resolution, or how can we approach market volatility with some sense of financial confidence?
Yeah, it's a challenge. I mean, I just gave a talk last night, actually, to about 30 retirees, and yeah, it's top of mind. I mean, just a balanced portfolio. I call it a boomer portfolio, right? Because the average boomer portfolio is 60% stock, 40% bonds. In fact, I just read an article through JP Morgan. We're an institutional client of Vanguard. I'm mixing up my big firms here. We also work with JP Morgan, but the average portfolio right now for retiree is 61% stock and 39% bond. And guess where that's at today? As of yesterday, a 60-40 portfolio is down 19% plus. That's painful. So what the real challenge is right now is the bond market, because normally when you have low inflation, low interest rates, you have the bonds act as a buffer. So market down 20, bonds up 5, 6, 7, you're down maybe 10%, give or take, right? And so the fact is that's the real pain. I mean, you have corporate bonds down 20%. You have long-term treasury bonds down almost 30%. It's the worst start of the year to the bond market ever. And so it's not your grandparents' market. It's not. Here's the challenge that we have, Peter, is that I always say to clients when we're doing planning, what got you to where you're at today is not going to get you where you want to go tomorrow. And what I'll tell you in a bigger picture right now is what happened the last 10, 20 years and how we manage money is not the same to have success in the next 10 to 20 years. I'll leave it at that.
And that goes for us on a personal level as our own situation changes and evolves over time. Our needs during our paycheck years and our retirement needs financially are obviously very different. But on a governmental level, the policy is very different today than it has been for about the last 15 years as well. We've gone from quantitative easing to quantitative tightening. What does it mean for the investors, the interest rates, and the fixed income market as the government has made this big shift, David? Yeah,
it's a big paradigm shift. That's exactly what you're talking about. You're giving a more precise example of what I'm talking about. When you have interest rates that are 0, 1, 2%, and now go from you've had federal funds rate go from 0 to 3% in 9 months. It's the fastest rise in interest rates ever. Okay, that's 12 rate hikes. Okay, because every quarter basis points, 1 rate hike, right? So you've had 12 rate hikes in a 9-month period, the fastest ever. So that's why the bond market's getting destroyed. People don't understand the client, the retiree doesn't understand how bonds work. As rates rise, the value of bonds goes down. So there's really no end in sight with it. Well, there's an end in sight. Powell just talked about, he just raised rates last week, 75 basis points. And for basically what they're forecasting is about a federal funds rate about 4 to 4.5, maybe 5 over the next year. And so maybe that's your ceiling. So what that means for the retiree is that that's more bond pain. That's the problem. Now, us as a firm, we're now finally looking, actually, believe it or not, little old short-term treasury bonds now. We haven't invested in bonds as an asset class per se in years. And now if you can get a 4% yield on a 1-year treasury bond that's guaranteed by the federal government. Now I'm talking about owning individual bonds. Right. So we're looking at putting together a bond portfolio of short-term 1, 2, 3-year treasury bonds because I'm guaranteed to get my money back. Right. I can get 4% income, maybe some appreciation. If you own the same portfolio in a bond fund, you can lose your shorts. So right now, that's a good example of what's happening. To dovetail back to your quantitative tightening, what that means in English is the Federal Reserve is pulling back liquidity. Instead of buying treasury bonds and corporate bonds and mortgage-backed securities, they're selling these bonds. And so just like anything else, it's supply and demand. As the demand for bonds goes down, the biggest buyer was the U.S. government, and now they're not buying. What's going to happen is rates are going to have to continue to rise. So there's equilibrium back in the market, and people are saying, okay, that's a fair yield, and we're getting to that level. That's the good news is we're getting to that level. I don't think we're quite there yet. It doesn't mean that I'm not going to stick my toe in the water now, because I'll be happy to get my client a 4% yield, right, for some of their portfolio and not have risk. But that's a very new paradigm. So there are opportunities. We talk about a lot of doom and gloom because it's easy to do. But if you're positioned properly and you're opportunistic like we like to be, there's opportunities now that are already representing themselves. And that's one small example of where we can get a pretty good return and not have risk in the markets.
And while volatility and this recent turbulence has been painful, the reality of where the market is right now, David, is not nearly as deep of a downturn as some previous market volatile periods. The dot-com bubble, the Great Recession, had much deeper declines than what we are currently experiencing. And in fact, downturns are often more frequent and deeper than most investors really realize or have expectations for.
Absolutely. I can tell you just right now, Peter, given that talk I did, the tone is different now. What happened in the first part of the year is clients were more apathetic, because guess what happened? What happened in 2020? The federal government came to save the day, Superman, right? Drop rates to zero, pump all this trillions of dollars in the economy. And guess what? That's how you can pretty much artificially stop the bleeding. We're on the opposite side of that today. The Federal Reserve is raising interest rates. We have double-digit inflation. Right? There's no savior right now. And Powell is hell-bent, which I agree with, on taming inflation. He has to, because it affects the masses. It affects the low paycheck worker. It affects the people that are in that bottom rung. And that's the people we should be concerned about. So the reality is that we need to be very careful going forward, because there's no life raft right now. I think we're probably halfway home. I'm not a big prognosticator. One of the, Warren Buffett has a great quote. He says, I'd rather, instead of predicting rain, let's build an ark. Right. I'm a religious man, so that serves double meaning for me. But that's how I look at the world. I want to build an ark for my clients. I don't want to predict the rain. If you were going to point a gun to my head and say, Dave, what do you think? I think we're probably halfway there. I think there's probably another 10 to 20% downside in that range. You're talking S&P 500, probably 3,300 is my estimation, has been all year. That puts us down another 20%. We're down 20% as of this particular talk. So again, I'm not in the business of prognosticating, right? I'm in the business of protecting capital first. And so we're very serious about that. And the reality is that that's a fool's errand. Markets like this, when you have these big rallies that we have, it's a time to reposition assets, not a time to say, okay, we got a new bull market, which the talking heads, when you had this last move up in the market of about 15%, everybody's talking about, oh, the markets, we have the bottoms in and everything's great. That's the people on TV talking up their own book and the people that were down 20, 30%.
In the hopes of building that arc and preparing, what should a proactive, retirement-minded saver or investor do in preparation to hopefully give us continued financial confidence regardless of what we see coming?
Yeah. What are the tool chests? What's the, what kind of wood do I need? What kind of tools? What kind of nails, right? That's kind of what we look at. We're financial architects, retirement architects. It's what we do. It all starts with a plan. It's blueprints, right? We got to have a plan. Everything we do is guided by our written retirement income plan. Because unless you have an income plan first, we have no idea how we need to plan for our investments, right? Most people don't even have an investment plan. They have a nice statement that says, here's your diversification. I call it diversification. But now we want our money to do a job, right? I want your money to, everyone has to work for you now. So the biggest key to that, because that's a great question, Peter, is we have to start with a retirement income plan. We have to solve for cash flow first. Then it says, because we want the most amount of income, you've heard me say, the least amount of risk and never run out of money. Most amount of income, least amount of risk, and never run out of money. So that's the mindset that we do for every single client. And you want somebody to think that way, whether it's me or somebody else, because I'm agnostic to the investment. The investment is a means to an end. using your arc analogy, I want to pick the best wood that has the best, can float the best, the nails that maybe rust the least, right? I don't care what it is. I care what it does. So you have to be in a position to where you can look at this objectively and not have an agenda and not have a perspective that you and an ego you hang on to. Stocks are great. Annuities are horrible. Real estate's we don't care. We use every asset class there is to help to protect, but it all starts with a retirement income plan, a written plan.
Well, if you would like a portfolio review and audit, give the retirement architect David Reyes and Reyes Financial Architecture a call, and they can put together that retirement blueprint along with you and for you. 858-597-1966. That's 858-597-1966. You can visit online at reyesplan.com. That's REYES plan.com, reyesplan.com, or again, 858-597-1966. David Reyes, the retirement architect. Always a pleasure to have your perspective on the program.
Thank you very much, Peter.
Thank you for spending your time with us again this week. Get the most out of your retirement plan. Call 866-REYES-PLAN. That's 866-REYES-PLAN. 866-739-3775. Or visit reyesplan.com.
No information presented today should be acted upon without meeting with a qualified and licensed professional. Reyes Financial Architecture, Inc., RFA, is an SEC-registered investment advisory firm. Such registration does not imply a certain level of skill or training. For a copy of RFA's current form ADV-2A brochure that includes a description of services provided, fees charged, and other important information, call 858-597-1966 or go to adviserinfo.sec.gov. RFA also is a licensed insurance agency with the state of California. License number 0G66604. This show is provided for informational purposes only. Opinions expressed in the show reflect RFA views as of the date of the recording and are subject to change. Nothing should be construed as a comprehensive statement of the matters discussed, considered investment, financial, legal, or tax advice, or a recommendation to buy or sell any type of security, and no investment decision should be made based solely on any information provided. Any forward-looking statements or forecasts discussed are based on assumptions, and actual results can vary from any such statements. Some of the information provided has been obtained by third parties and believed to be reliable, but not guaranteed. Past performance is not an indication of future returns. With respect to any discussion about RFA investment strategies, there's no guarantee that they will be profitable or perform as described during the show. RFA or one or more of its employees may have a position in the securities discussed and may purchase or sell such securities from time to time. All investments in securities carry risk, including the risk of losing principal amount invested. Different types of investments involve varying degrees of risk. There can be no assurance that any specific investment or investment product will be profitable or suitable for a particular investor's financial situation or risk tolerance. Asset allocation and portfolio diversification cannot ensure or guarantee better performance and cannot eliminate the risk of investment losses. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing insurance company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Surrender charges apply to base contracts. Optional life income benefit riders are used to calculate lifetime income payments only and are not available for cash surrender or in a death benefit. Fees may apply. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. Rates and returns mentioned on this program are subject to change without notice.